Alright, finally, robot Zelda. 3 parts today. We will talk about Zelda's entry rules, exit rules, and sizing. And just to reiterate, Zelda is meant for educational purpose. It is not meant for live trading as it is. So we know that we are building a 8 currency hedging robot. And we have learned the meaning of hedging. So let's examine the general idea behind Zelda. We have 8 currencies. If any of them deviates too much from the others, we will make a trade or bet that this currency will converge back to the rest. So if you were to think of it from a previous lecture point of view, this is what we call an imperfect hedge, and what we are trading is relative value between currencies. So we use an example here. We have 3 currencies: currency blue, orange, and purple. And in this hypothetical scenario, the prices of these 3 currencies, they move in roughly the same manner. So what if one of the currency, so in this case currency blue, prices diverge from the rest? Our assumption is that we expect the price of currency blue to converge back to currency orange and purple. And note that this assumption may or may not hold true in live trading in the markets. This is just a hypothetical scenario. In this case, we will short currency blue, long currencies orange and purple. And hopefully, if blue converges back to currency orange and purple, we will make profits. So here is another example. Imagine if both currency blue and currency purple diverge. In this case, if we assume that this divergence is temporary and they will converge back to the mean, we will short currency blue and long currency purple here. And if they do converge back, we will be profitable for this trade. With that in mind, let's look at Zelda's entry rules. We have 8 currencies, which give us 7 currency pairs. We need to find this mean, this average level where the currencies should converge around. To do that, we shall so-called average the prices of these 7 currencies to form an artificial price. And this price will be known as our combined index. And when I say average in double quotes, I don't actually mean we add all of them up and we divide by 7. There's a method to do it, and we will show you that later. Alright, so now that we have our combined index, our hypothetical mean, let's examine when do we fire a trade. We do it when at least one currency pair deviates too much on the positive side, and one currency pair deviates too much on the other side, so-called the negative side. Looking at this chart, this will be our so-called positive side, and this is our negative side. The trade shorts the currencies that deviates to the positive side, and longs the currencies that deviates on the negative side. So let's talk about some definitions and terminologies. Whenever there is deviations and we fire a trade, we don't mean that every currency is a trade. We think of this whole system as one trade, and every buy and sell order is a leg. So there are 7 currency pairs. That means that there are a maximum of 7 legs to fire and a minimum of 2, because we need at least 1 on each side. Alright, so take note of this. Don't get confused when we start coding later. And also we check for deviations once every candle bar, meaning at the start of each bar we will do it. We will explain why we do it this way and not once per tick in the lecture where we talk about coding Zelda. Alright, so let's visualize Zelda's entry rules. First example, the thick blue line is our combined index. And remember, this combined index is a so-called imaginary line. It does not exist as a tradable asset. It is something that we calculated. So in this case, Euro USD deviates more on the positive side, and Aussie USD deviates more on the negative side. So we were short Euro USD, long Aussie USD. Second example, in this case, NZD USD and Euro USD deviates from the positive side. Aussie USD and our US yen deviates on the negative side. So we're short the Kiwi and Euro, and we're long the Aussie and the yen. So now that we know when do we fire the trade, let's talk about the creation of our combined index. How do we build this index? As mentioned before, one way, which is the wrong way, is to combine all prices and then dividing them by 7. So take 5 seconds, think about it. Why would this be wrong? Let's imagine different currencies have different prices. For example, our Euro USD is 1.2 something. Our Aussie USD is 0.7 something as of today. Yen is 106 point something. A 10% move in the yen will equate to $10. A 10% move in Euro USD is 0.12. A 10% move in the Aussie is 0.07. If you were to just add them all up and divide them by 7, it will put excessive weightage on the yen, which is not what we want. We want all 7 currencies to be of equal weightage. So obviously that can't be the weight. The method we use is we need to normalize these prices so that they are on an equal footing of sorts. So method 2 is our method. We create a common starting point. We choose a value in the past, 5 days ago, 10 days ago, 20 years ago, whatsoever, or even a year ago. And that point will be our starting point. That point will be the starting point of our combined index. And we set that value as 1. Then we calculate this value as the time goes by. And we calculate it based on the change in prices of the 7 currency pairs. Note that there are more complex methods. There are a lot of methods, in fact, for doing something like this. Bankers and those in hedge fund create their own ways to build ETFs that track a certain index. But for now, this is the method we will use. So let's talk about details. We just talk about the general idea of how we can do it. Let's talk about how do we exactly do it. We choose a time in the past. We are going to choose 20 days ago. This is an arbitrary figure. If you want to be more specific and more prudent about this, what we should do is to develop backtests, optimizations, try to break down the logic of this combined index based on the economic and market fundamentals. But right now, we're not going to do that. We just choose a time in the past, which is 20 days ago. So the value of the combined index 20 days ago is 1. And we will calculate this index value for the current day based on the prices of the 7 underlying currencies. This is a numerical example. Take 10 seconds to look at this and see if you understand how the calculations are being done. Okay, the CI represents our combined index. Shift 0 is today. Let's start from 20 days ago at shift 19. We know that CI is 1. The CI 1 day later is 1 times the average change of the 7 underlying currencies. In this case, I'm just going to use 3 currencies instead of 7 because I can't fit all 7 currencies in this slide. Yeah, so these 3 currencies Euro, USD, Pound, Aussie. The change in these prices are 0.3%, 0.6 and 0.3. The average change is 0.4. Therefore, the CI on shift 18 is 1.004. Alright, 1 times 0.4%. And the CI for the next day is 1.004 times 0.5%. Note that when I say 1.004 times 0.5%, the actual calculation will be 1.004 times 1.005. Otherwise, you get a wrong calculation because it's 0.5% increase and not 0.5% of this value. Keep doing that and you will get the CI for today. So now that we have discussed how we create our combined index, let's talk about deviations. We mentioned that if one currency pair deviates too much, we will fire a trade. How much is too much? We let this deviation be X amount, where X is the average daily change. Again, this is an arbitrary figure. So the average daily change for the combined index in the last 20 days. Thus, we get the change every day and we divide it by 20 arithmetically. Some of you may wonder, well, shouldn't we consider compounding? So instead of having a total change over 20 days divided by 20, you should take that value to the power of 1 over 20. We will keep it simple for now and just use arithmetic division. If I were to put the deviation into the chart, it would look something like this. These two blue arrows represents our deviation distance. If the currency prices move above the top blue arrow or below the bottom blue arrow, we have a trade. Thus, to summarize for entry rules, when at least two currencies have price deviations, one on each side, we fire a trade. We short those that deviated on the positive side and long those that deviated on the negative side. I know this may be a lot to take in right now, but don't worry, when we look at the coding, you'll get a better understanding on how the entry rules are designed and put together. Exit rules. Don't worry, this will be very simple. As long as we have 3% in profits, we close all trades. If we have 1.5% in losses, we close all trades. That's all. Sizing. We will not have any complex sizing algorithm. 2 points. First, only one trade can be held at a time. Second point, we will fire 3 lots, 1.5 lots per side, and we divide them equally among the number of legs per side. Thus, for example, imagine if we have a trade that has 3 legs on the positive side and 2 legs on the negative side. We will have 0.5 lots on each of those trades on the positive side and 0.75 lots on each of the 2 trades on the negative side.